So, good morning, everyone. A very warm welcome to our webcast today about the European real estate markets, the forthcoming trends and opportunities. I'm really happy you guys joined today. The idea for today is that together with my colleagues, Corinne Dubois, who is an expert economic analytics analyst, then Annika Steiner, who's partner and managing director in Germany, and myself. So the three of us, we want to give you our furthest insights, our newest analysis around the European real estate market, especially though about France, Germany, and Switzerland. We will start with a short introduction about the European real estate market and then go in depth into the three countries later on. If you guys have any questions, feel free to ask them in our chat. There's an F&A section where you can put your questions in it. If we have time and if it's possible, then we will answer these questions straight away right here. If it's not time for that or we're running out of time, then we'll definitely come back to you in terms of your questions. So let's have a look at what happened in the European real estate market. Maybe some of you guys know Wirtschaftspartner turned 40 years this year, so had the 40th birthday. And this was an occasion why we were asking ourselves what would have been if we would have invested 100,000 in any currency like 40 years ago until now. And this is basically showing this analysis a bit longer view over the last 4 years when you invested in indirect real estate, so in stock listed companies. And yeah, the results are quite impressive, I believe. So Hong Kong, you could have now out of 100,000 Hong Kong dollars, then 6.6 million today or by the end of last year after 40 years. Australia, Norway, Sweden were in the forthcoming places also with quite impressive returns. France and Switzerland, like in the middle. Also in Germany, you could do a return a positive performance, but it was not so much compared to the others. So quite impressive numbers, I believe, but the huge differences between the countries are explained a lot by also in the inflation in these countries. So when we adjust the performance by the inflation of these each countries, the result looks quite different. So then not Hong Kong is on the top, it is Norway and Singapore with 1.7, 1.8 million of the respective currency. Hong Kong is on the third place. We see Switzerland and France in the middle still, also with a very strong positive performance over the 40 years. And but when we do it, the inflation adjustment, we see also one country, which is Canada, where you would have made a loss after 40 years investment in the real estate market for stock listed companies. So yeah, the picture is different. What was also two other things I wanted to know then, where is the risk or the performance best related to the risk? And this is something you can show by calculating a Sharpe ratio, which basically takes account the performance on the one hand side, as well as the risk-free interest rate of each countries and the risk, like the volatility over the years. And this then shows that the Sharpe ratio can have a number between negative area if it's a loss, but like between 0 and 1. 1 is the highest, and basically also they're showing a very good, very efficient investment. The higher, the better, basically. And here we can see that Switzerland was, in terms of the Sharpe ratio, the best country. So meaning the performance in in relation to the risk, this ratio is very positive or on a very good side in Switzerland. So the performance itself wasn't as high as in other countries, but in the same times the volatility was much lower at the other countries like Hong Kong, Australia, US, and Norway especially. So we see here that the countries from the performance on the top, like Hong Kong, Norway, Singapore, are in terms of the relation between performance and risk in the midfield. Other countries, Switzerland and Australia, are on the top. So we're basically showing in these countries a very good relation between performance and risk. And another thing was also, I think, is interesting when you change the investment starting point. I mean, this period and we analyzed here was 40 years, and it was basically just a reason because Rios partner is turning 40s. But what would happen if you changed the observation period as well? And this, for example, when we look at the last decade between 2010 and 2020, then we also see totally different ranking here. Germany is on the second place with over an average of over 15% performance per year. We see Hong Kong and Singapore, which were on the top on a 40-year perspective, are now more on the bottom of this ranking. Basically, this shows it's all about the momentum, all about the right investment point. If it's a 40 years perspective, different countries are on the top. If it's a short-term perspective, then countries which were before on the bottom are now on the top. So it's all about the right momentum, and this is basically something we want to look at it today. Is now the right momentum? Is it early? Is it late for investing in real estate market? And yeah, this is the goal for today. And so let's switch now to the shorter view, the recent developments in the market. Also a few slides just about the Europe market in general. We see now the performance of these stock listed companies in average in these countries. We see at the moment in 2025 a huge demand for investments in real estate in Southern Europe, such as Italy and Spain. Residential is very in favor there for the investors. Also student housing and other segments, senior living as well. So we have a very strong performance in Southern Europe. Also France is very up there, and Switzerland in the middle. Then what is interesting is that when we compare it over the last 5 years, which included the COVID crisis on the one hand side and the rise of the interest rates at the second hand, and the second point. So basically 2 moments where we had huge turbulences in the market and the performances went very often a few months in the negative area. And then it's the question, which country is now back on the peak before 2022? And those countries who are here with the blue bars in the negative area, they still not back yet on the peak where they were before 2020. And it shows that in Europe, many countries are still on the way back to the top, not there yet. France is slightly above the top. Switzerland is above the top. Also Spain as well. But all the other countries, we can see a momentum at the moment, but still a way to go to be back at the peak. Next thing is where do we see cities, or what cities do we believe in Europe have a potential or high chances for direct investments? And what we did here is analyzing the real estate risk premium right now compared to the average of the last 10 years. And the real estate risk premium is calculated by seeing the prime yields compared to the yields of bonds 10 years of these respective countries. And the higher this risk premium compared to the average of the last year is, the more chances there are that you will get rewarded more in terms of real estate investments than compared to the last years. And here we see Prague, Amsterdam, Paris La Défense, also German cities like Berlin, Munich, as well as Milan in Italy. These are right now, the real estate risk premiums are higher than compared to the average. So this might be chances to invest here. Obviously, still selectively, there might be reasons why the risk premium is now higher compared to the last 10 years. Could be the government, could be the real economy, development, vacancies, and so on. So there might be reasons behind that. Nevertheless, the comparison to the average shows a potential in quite a few cities of Europe. On the other hand, we see cities where the risk premium at the moment is below the average of the last 10 years. And these were then, on the other hand, cities which where the potential is not as high out of this perspective compared to the ones with the blue bars. And here, a quick overview how the prime rents developed over the last 5 years since beginning of 2025. What I won't go too much into detail in all the cities here, but what we see in general is that there is a polarization still happening between cities with a high prime rents, where the demand for offices is very high, and therefore all the prime rents are pretty high. Whereas other cities with a lower demand, they more struggle to increase the rents. So there is not a strong, but a weak tendency of the higher the prices are at the moment, the more it raised over the last 5 years. And there are areas with a lower prime rents, the changes there were lower over the last 5 years as well. So it shows basically that the polarization, the demand still goes there much more where the demand for office services were high before. And it's, the polarization still going on, which we also can see sometimes within the cities, that the good locations, the very good locations, that they are also the one with the highest demand. This was a quick overview over the real estate market in general in Europe. Now I want to hand over to you, Annika. You have been to the expo the last 3 days. Thank you anyway for joining this web call today. Tell us a little bit, what did you see? What was going on at the expo?
Yeah, it was really 3-4 days for me. It was the atmosphere was slightly positive, I like to say, like you mentioned before, a bit positive momentum, but we are not yet that it's really becoming really very positive. So, and somehow nobody was really clear with, was it much fuller than the last years or a bit more empty than the last year? So it was how somebody I talked to was, no, it's a bit empty, and the other said, no, it's really crowded. And so it was really not so clear, the statement from the audience. And the most interesting topics, I think, were somehow infrastructure, AI, how will AI change the real estate industry and the way we are working in the future was really big topics. Then, of course, how will the Germany in total will develop in the next future? How will the politics impact come into the branch? And so there are still a lot insecurities, like to say, about the future of Germany in total and for the real estate market. And so the news are not so, I don't have the phenomenal super news here for you because there is not so much happening right now in the market because everybody is still a bit waiting. We see some transactions here and there, but not so that everybody say, okay, now we have the change, it will rise like you mentioned earlier before Corona or something like that. So I like to switch into my actual figures, and then I will come back now and then to my meetings I had on the Expo Real, so that we can have a really fresh look to it. So I have to share my screen, one moment. Yes, so here are my slides. I hope you can see everything. And first, we want to have a look at the economic context. So what we can see where Germany is actually at. We see that the real economy is still a bit fragile, not so clear, positive like we all would to have it here. I have the numbers here. You can see my mouse, hopefully. Here, the numbers of the gross domestic product. Here you can see in the first quarter, it was slightly positive. In the second, it was slightly negative. And so it's still a bit, not so clear what is coming next. And the labor market is stable. The employment moves sideways, so there is not so much happening as well. But stable is a good one on the other side. So the inflation is stable as well. That's kind of good news, because due to the tariffs of the US, there was a bit insecurity if there will come more pressure to the prices. And so we have still a rising in the inflation. So at the moment, it's stable. And so the effects of the tariffs are not so shown yet in the numbers. And on the right side, you see a chart where we have the interest rates in Germany, and the blue line is the interest rate of the ECB, and there you see it's stable over the last weeks or months, like to say, and that also reflects that they are looking what's happening now, how will the impact of the US tariffs reflects in the market, and if they have to do something or not, because the situation is really fragile, I like to say. When we just have a short look on the construction prices, well, here it can also happen that due to the new tariffs, the prices come up a bit more, and then more pressure come into the market. That was all over the Expo as well. The question, will there be clear increase in building activities again, because that's make a lot of pressure especially in the real estate market, that the actual numbers of building are really low, and the federal politics say we want to increase it and bring something into the market, but if the construction price will rise again, so that will be a really hard time then again. And here you can see they are not so changes are not so high like we have in 2022 and 2023. They are on a stable level around, let's say around 3%, but still somehow rising, and that makes building a bit difficult in Germany. When we will have a look on the forecast, here you can see in the first line is the current year for economy, population, inflation, and government bond. The yellow line is then the expectation for next year, and the third line here you can see the review of the previous years, what happened. And so we see some upside risks here and some downside risks. I marked here on the slide as well. So we have the political instability, which should be resolved by the election of the new government, but it's still, they have to come up in the actual working and make some changes. And so here is still a bit risk, as well as they try to stimulate the infrastructure and defense with a lot of money. So we are really curious how that will impact the market as well. And yes, from the downside risk, I think population and employment is sideways, and we have to see how the geopolitical situation and the trade risk will move on here. So it's really, yeah, it depends on the next month what happened really. And I just want to highlight, I mentioned before, how the effects of the US tariffs on the German economic are or could be. And here on the left side, we have a chart. The IFO Institute made a study or research how the impact could be, and they made it in summer, in June or July, before the actual tariffs was there decided. So the first scenario is that the scenario what's more at the moment the actual one, because they estimated basic tariffs of 10%. Now we have 15%, so we can see the impact about the different economic sectors is different, of course, and we see that in the manufacturing industry it will be most highest impact, and on the other side there can be some slightly positive impact for the services, because to the tariffs can be the services from US be higher, and so the regional can be profit from it. So it was a really curious English now, but I think you get what I want to say. Sorry. Yeah, and the US is the most important export partner for Germany normally, and so it really is it's a really tough one for Germany, and for the real estate industry it has some implications as well, because a big exporter is the pharmacy, and of course the car production, and both are really area resource intensive branch. So it will have an impact if somehow the pharmacy developer decide to go to US directly and don't have their locations here in Germany. So there will become some demand changes probably in logistic and retail sector and office spaces as well. So for example, in Berlin, pharmacy is a really big sector, so it will have impact on the real estate market in Berlin, of course. So then we have a look at the investment market. Here you can see what I mentioned about the Expo, that there is not so much news here, because the investment volume is a bit on the same level over the past quarters. It's slightly higher than last year, but not so much. So it's really nothing really happened here. The asset type still, perhaps it's different from before the crisis, that living is the biggest share of asset with 32%, retail 70%, and office 20%. And that was my impression from the Expo as well, that residential is still really attractive market, and office is still a bit under, on the watch list, I like to say, because it's still a bit unclear. We see it here as well in the prime yields for office from the big cities in Germany, the top 7. Munich is the most expensive market right now, then Berlin and Hamburg. And we see or hear that some companies say that the employees have to come back to the office. No home office is more possible. So there you can expect that the demand will increase. But on the other side, when we have site visits and are in the office locations, there you can see that there are a lot of empty desks still. And I talk at the Expo with a provider for workplace Buchung, where you can actually charge your place at work, and there is a decrease in the demand, he said, and actually everybody wants to know what is the actual usage of the office, and they want to really track if the desk is used or not, so that they get a better feeling if there is really something in the office or not. I think there is still something happen, and the pressure on the market is still there. And on the other side, when we have a look at the residential market, the yields are stable as well. But as you can see on the right hand, you see the development of the asking rents. And here we have different sizes, and the gray light is the top 7, and the blue one is some municipalities without classification. And so you can see we have a lot of really hard decrease in the rents. And now we have, for example, in the top 7, we have reached a really high level, and due to the high indexation and the high cost of living, it's really hard for the people to have more money for the rents. So there is a pressure, and I think there is now a bit, the highest level is reached, and so we have to see what happens next, because on the other side, there is no offer right now coming new because of the low building activities, and the residential market is still under pressure. And when you want to have an investment, everybody wants to invest in residential because it's really promising because of the high demand and the rent increase. Yes, and that's from the German market here at the moment. And I can hand over to Corinne so that we can have a look what happened in France.
Thank you very much, Annika. Let me just, so you can see my screen, I believe. So thank you very much again for the overview for Germany, and we are now going to have again a look, but now more precisely into France and what are the recent developments and the perspectives for the French real estate markets. We are going to start again with the economic and investment environment. So the current situation in terms of the economy of France is that the economy is actually remaining fairly stable. So the GDP growth forecast for this year should be plus 0.7%. Yes, it is a very moderate growth, but nevertheless, it is a positive growth, which is not so bad considering the international uncertain context and especially the political crisis that France is currently going through. So in terms of employment, also, we have seen 2 years of very strong growth, and now it's more like in Germany, basically a sideways movement, which is reflecting a more cautious, let's say, business climate. What's also interesting is the evolution of the interest rate. So same as in Germany, we have that the ECB basically set the policy rate at 2%, and that is stable since June. What is, however, different is that the sovereign bond yields continues to rise in France. It has reached 3.5% in September, and the spread relative to the German bond yields just keeps widening. So this situation basically reflects the political uncertainty and the very high public debt that we have in France, and also shows the lack of confidence of the investors in the ability of the French government to actually bring that debt under control. That being said, we also see more and more companies in France that are able to borrow at a lower rate than the government. So it shows that after all, the investors are still trusting the fundamentals of the French economy, which is good news. Nevertheless, it is still the case that this political deadlock is weighing on the economic activity. As you may have heard in the recent news, we have that the Prime Minister Lecornu just resigned 3 days ago, only after a few weeks of being in service and 14 hours after naming his government. So now again, there is not really a government and the uncertainty is extremely high. So in this context, what is happening? Well, the households are being cautious, they save more, they invest and consume less, and also the firms are postponing their investments. So those are both clear signs of precaution and hesitation in the current context. So let's now take a quick look ahead. So our expectation is that the French economy is going to slightly accelerate next year. So the GDP forecast for 2026 would be around 1%. a bit higher than this year. And why do we believe there could be this slight acceleration? Well, first of all, there could be stronger momentum in the Eurozone. There is the fiscal stimulus package in Germany, but also in general an increased investment in infrastructure and defense that should boost the economy. The low inflation also should support the real wage growth, but nevertheless, this will only translate into additional consumption if the confidence is a little bit restored. In terms of the long-term bond yields, the expectation is that they would rise even further next year to 3.7%, reflecting higher risk premiums. So it is the case that the political and budgetary crisis in France remains a very important challenge and is causing cautious behaviors by both consumers and firms. Of course, the geopolitical risks are also to keep in mind and could weigh on the confidence. Now let's take a look at the investment landscape and more specifically at the indirect investment. So what we can see here is the yearly performance of the STIC, what is called, so the Société d'Investissement Immobilier Coté, which is basically the French equivalent of REITs. So this year, the French SICs have shown a very strong performance, 20% increase between January and September of this year. And this strong performance was mainly supported by the ECB's accommodative monetary policy and by improving financing conditions. What we also see is a return of the core investors into the market. So many of the long-term players were reintegrating the SIC shares into their portfolios. Basically, these shares were heavily discounted before in the recent years, and many investors now view those discounts were maybe excessive, and so they return on the market. Another important factor here is the tightening of the ESG requirements in the real estate sector, basically. So a lot of the private owners face major investment obligations. And as a result, this strengthens the position of the large and well-capitalized SICs. And at the same time, this greater ESG compliance is also boosting the confidence among international investors. So overall, 2025 marks, I would say, a turning point. We have a bit renewed confidence, improving financing conditions, and a more selective but also more solid investor base for the indirect investment. In terms of the direct investment, here, I would say the recovery has been more gradual, but it is also becoming visible. So after several challenging years, the investment volumes in France picked up again in the first half of 2025. So they rose by about 11% compared to the same period of last year. And what is also very striking is the shift in the market structure. So if you look before COVID, traditionally the offices, they accounted for around 60% of the total investment. But in the last couple of years, they have fallen to less than 1/3 of the volumes. And at the same time, what we see is that industrial and logistics assets have really gained momentum. So they were even for the first time higher than offices in 2024. And then also hospitality gained momentum last year. Nevertheless, if we look at the first half of this year, we see that the offices start picking up again in terms of the volumes, mainly thanks to some large transactions in the Paris region. The activity outside the Île-de-France region remains extremely low. Retail volumes are slightly higher and logistics actually stabilized, but on a high level. So next, we're going to take a closer look at two segments that are very important in the commercial real estate, i.e. offices and industrial and logistics. So let's start with the offices. So what we see now on the office market, and Robert mentioned it a little bit, but this is really very clear in France, is that the rents are continuing to polarize very sharply. So this is really this phenomenon of flight to quality. We have a demand that remains concentrated on the prime locations in central Paris, and there we have that the rents they keep climbing, and now they reach 1,170 euros per square meter per year for the top spaces. At the same time, we see that the rents in the less central areas in Paris, as well as the rents in the other major French cities, are under pressure. Basically, the landlords would prioritize keeping occupancy levels up rather than pushing for higher rents. However, this these ever rising rents, if you want, in the central business district could also drive to a rebalance and move or an affordability squeeze, because only a limited pool of occupiers can afford the prime rents, especially in today's context. So looking ahead, we could see some stabilization as the demand might gradually rebalance between the locations. Now let's also take a look at the vacancy trends, and also here the contrast is very striking. So overall, the vacancy rate in Greater Paris region for the offices was 10.7% in the second trimester of this year. So that's like the highest level in over a decade. But this very high level also hides very huge geographical differences. So in central Paris, the vacancy remains quite low, around 5-6%, because there we have a lot of demand for the very well-located offices. In contrast, if you look at La Défense, we have a vacancy rate at around 15%, which is triple its pre-pandemic level. And also in the Western Crescent or the inner suburbs, we have vacancy rates nearing 20%, so showing basically a clear case of oversupply. So there is this flight to quality and flight to centrality phenomenon, but it's also an effect of the ESG regulation. So especially the older suburban assets, they often fail to meet today's ESG standards. With the Éco-Énergie Tertiaire rule, we even require a 40% reduction in energy consumption by 2030, and this would push up the capex needs. So a lot of these older suburban assets, they just don't meet the expectation and they linger vacant. Looking ahead, the outlook, I would say, is still cautiously optimistic. So we might see some rebalances of the demand. We have also the return to office policies, which Annika mentioned earlier, which could boost a little bit the use of the space. And the very best located buildings face a very limited supply. But at the same time, employment growth is subdued, so the demand impulses are a bit weaker. And finally, some more encouraging news is that the performance of the office assets finally turned positive again in the first half of 2025 after 2 years of negative total return. So there are already some signs of regained confidence in the sector. Coming now to industrial and logistics. So industrial and logistics assets is the asset class that has delivered the highest performance over the past decade. So the total returns were around 10% per year on average between 2015 and 2024. So the sector resisted very well during COVID, and it continues to benefit from some structural tailwinds like the growth of e-commerce, the need for faster delivery networks, the reindustrialization, reshoring trend across Europe, and also higher public spending on defense and infrastructure. So France should be one of the main beneficiaries of this renewed industrial focus. Could attract large-scale government-backed investments that drive the demand for logistics and also for manufacturing real estate. The main challenges, however, remain the external uncertain international context or the risk of new tariffs, barriers to trade, which could have a negative impact on the momentum. And also here we see a clear geographical pattern. So basically we have this north-south logistics corridor, what they call the dorsal logistique in French, which stretches from Lille to Paris, to Lyon, to Marseille. So this corridor is particularly attractive because it connects the main economic and population centers in France. It offers very good transport infrastructure, high accessibility, and a very dense consumer and industrial markets. That's along this corridor that you have the deepest concentration for demand, which results in faster lease ups, but also lower vacancy, stronger competition among buyers, which then results in turn in sharper yields. So for example, if I take Lyon and Marseille, we have prime yields that are around 4.7 until 4.9%, which compared to yields higher than 5% in markets like Toulouse and Strasbourg.
Sorry,
yes?
I think your slide's not shared anymore, just for the rest of it.
Okay. Why not? I'll just reshare it.
Yeah.
Voilà. It's the last one anyway. Is it okay now?
Yes.
Yes.
Okay, thank you. Yes, so basically comparing Lyon, Marseille, and Lille, where the yields are much lower than markets like Toulouse or Strasbourg, which are outside the corridor and have yields well above 5%. But also here in this market, selectivity is increasing. So basically new ESG compliant, flexible warehouses located near the major transport routes will remain in very high demand, where in contrast, older or more peripheral assets could find it harder to attract either occupiers or buyers. And this is it for the overview for France. I thank you very much for your attention, and I hand over to Robert for coming back to Switzerland.
Thank you very much, Corinne and Annika. Very interesting. The last few minutes, I will share my slides again. Here we go. Yeah, and I mean, when we compare Switzerland right now at the moment, there are definitely some similarities to Europe, to France and Germany as well, as especially when it comes to being exposed to the US tariffs, or maybe as an uncertainty in terms of the future economic development and so on. So there are definitely similarities, but on the other hand, the real estate market in Switzerland, I think, is one of the ones at the moment with the strongest confidence. There's a lot of money flowing into the market, mainly because there are not many alternatives right now due to the lower interest rates. And this is basically represented on the capital increases, which we see on the capital market. Stock listed real estate companies, funds, pensions funds, and so on, raised a lot of money in the last few months. So the capital increases for indirect investments will probably lie up to 7 billion this year. And this is much more as we have seen in the last 5 years. It also shows that at the time of 2022 and 2023, where we had negative performances, on the one hand side, also not so many capital increases, this time is nearly over. So the confidence for the Swedish real estate market is quite high. Money is coming, and this is also then represented how the prices develop in Switzerland here for investment property. And we see on the right, on the red line, this is the prices for investments object in the residential area, and blue line is commercial area. We see there is, like, the red line is basically increasing, has been increasing over the last 10, 11 years. There was in 2022 a decrease here where we had this increase in the interest rates. The stabilization followed pretty quickly, and now we are on a rise again. So we have a year-to-year increase in the prices for residential of 5%. Even for commercial, it's 4%. These are quality adjusted price developments, so changes in prices due to different objects are not here represented. So it's only the effective price changes, and it shows how high the demand is for real estate in Switzerland at the moment. On the one hand side, on the other side, represents it as well that the liquidity in the market is a main issue. There are not that many objects on the market. The investments opportunities within the real estate market in Switzerland are, in certain areas at least, quite limited. So this is also a main reason why there is the price increases, which we can see here now. What does that mean now for the net initial yields? Quite obvious. If the price is rising with stable income, the net initial yields will decrease, and it decreased in 2025. These are dates. The data which is included here is transactions until summer this year. So there will be coming more transactions in the second half of the year, which is usually the more active half year per year anyway. But nevertheless, it's a quite stable indicator for the moment for 2025. And we see a decrease in the net initial yields of 30 basis points to 3.1%. This is overall over all categories, and shows, yeah, this is the run for Swiss real estate is basically represented also in a quite big decrease in the net initial yields. What is here also a reason for this decrease, or can be a reason, is the mix of the transaction. For example, it can be that we have this year more transactions of better objects or better buildings in a better shape or better location compared to last year, and this quality differences to last year's transactions might influence this development as well. And when we take this into account, that these quality differences, and do a regression based on that to calculate it out basically, then we see that the net initial yields is not increasing as sharply as it is here. It's more like 20 basis points increase when you compare it quality adjusted. And one last thing I want to point out here, we are already almost on the same level again as we were in 2021. So just before the year of the rise in the interest rates. This basically shows that there's not much more room compared to the lowest net initial yields we had to either further decreases of the net initial yields. So we were quite not there yet of the low level of 2021, but we are very close there. So further declines must more are not so much than interest rate driven, much more out of other reasons. But it's also a belief why we think the decreases in the net initial yields will not go the same trend in 2026. It will be much more stable last year, or more on a certain level. Slightly with a decreasing trend, but not as strongly as this year. One thing, one reason why the investment or the confidence is back is definitely the demand for offices, but also especially for residential. This is due to the high employment changes which we had in the last year. We see this in the blue columns here. We had a very strong employment increase in Switzerland in 2021, 2022. It was above 2% per year, even in 2023. We had a high employment growth, and this is one of the reasons why the population growth then started to be faster, and this increased then the demand for residential. So this income perspective is still very in the mind of many investors here. But what I want to point out here as well is that there we see a decrease now in the population growth and the employment growth. We are still in a positive area. We have every year more new jobs, but the numbers of jobs is decreasing. It's not that much more new ones. And this has impacts then of the incomes in the office markets, or will have incomes next year or in 2027, 2028. And it also has an impact on the population growth. The less new jobs were built in Switzerland, the lower the population growth will be. Still, it will be in a positive area, but nevertheless, the population growth, which we had in the 3 last years, we shouldn't expect this to happen in the next 3 years. It's much more on a more normal level in terms of employment and population growth. Also shows a bit of normalization of the market. Other point is construction activity. We see here, we know that we had not enough construction in especially residential market, represented here in the decrease by the numbers of permits per year. But now we see an increase for the last 6 quarters, I believe. Especially in the rental apartments area, we had much more, or not much more, but a few more projects and a few more numbers coming to the market. The newest numbers indicate a little bit that this peak won't be a peak which will increasing even more or being on a sustainable long horizon. When we look at the building permissions or the building applications, then we see that it might go down a bit. So this height here can be not quite sure yet, but it could be more like a temporary high. So the construction activities in the next years will be more, even though we had an increase here, will be more a challenge still. So, yeah, at least we have a slight increase compared to what we had the 5 years before. What do we think in terms of the rents here for the residential market? We had sharp increases for demand rents. Now the newest numbers show that these sharp increases in rents are being more stable. So this is what we expect for next year. An increase in the rents by far is not as much as we had in the last 2 years, more like in the area of 0 to 1%. We will run our models next week, so then we will be precise, but I expect it to be much more close to this range. And when we look at the rents for the existing rents, which is represented in the blue line here, due to the lowering of the reference interest rates during this year, we expect a negative performance. So here, more like a normal development in the future as well, especially the income also for existing rents won't increase next year. It's much more on a very stable level. One main issue, I want to go too much into detail, but this will definitely have an impact on the real estate markets, and sometimes investors should be aware of that. The increase that the risk into the real estate markets are increasing much more in terms of the changing in regulations. This is an overview what is discussed at the moment in several communities, several countries on national level. Some cantons already have much more tenant protections. On the other hand, this other cantons or communities are voting on that. There will be national stronger national protection voted for in 3 years' time. We have also initiatives about the 10 million person Switzerland, and this is definitely something which we should have even stronger in mind when talking about risk for the future for the Swiss real estate markets, and these risks, they definitely will increase. To sum up, 5 key takeaways. We can see for Switzerland 2025 a clear rebound. The confidence is very strong at the moment. We see also a growth which was mainly driven right now by the lowering of the interest rates, by missing investment alternatives. But the future growth for investments in Switzerland in the real estate markets, it will be much more the income-driven part, so that the impacts by the rate is lowering down the next years. We still have a very strong residential market, a resilient core. Also segments like senior housing, student housing are very well on the agenda of many investors in Switzerland. But here, as I can just saw before, the risks are not lowering, might be increasing due to not so strong population growth and maybe more regulations. So this is what I want to say with mind the risk, the regulation part, the earning part, and also the liquidity. These are other things, or the risk which we should have in mind so far. That's from my side for Switzerland. I just
I like
check
your
if there are
summary
any.
with the key takeaways. I think I missed it for Germany a bit. And so I'm not sure if we have some questions because it
At the moment,
doesn't show
not.
something. Yeah. So then I can summarize perhaps for Germany, because as we started, you asked the question, is there is an actually good moment to invest in real estate in France, Switzerland, or Germany? And I think I would answer the question with yes, in Germany it's a good moment to invest in real estate, because there are a lot of positive implications. I think all other countries are looking really positive to Germany. Just the German market participants are a bit, German angst is a word which showed up a bit more often over the last days at the expo. So I think there are some good chances that you make now a really good investment, because I think the market will rise up again in the next month because of, I think it will be a good moment now. So.
Yeah. This is a good point that you say that, because there is something which we will focus on another podcast or webcast, which will held then in the 19th January 2026, investing in German real estate market from abroad. It's a content will be structured, the market size relevant, typical target returns in German, also practical guidings around certain points will here be the main topic. If you're interested in this webcast, please go on the website. You can register you there. It will be in German then, not in English, on the 19th of January 2026, our lunchtime.
That's great.
Yeah. I think there's
we're
no
already talking about next year.
What's that?
I think it's, I was wondering that we are already talking about something in the next year, because we are in the third quarter and now, time flies. Okay.
Yeah.
Nothing.
It's already the fourth quarter, by the way.
Yeah, really.
Yeah.
Okay.
All right. Thank you for your attention, everyone who joined. If you have any questions coming up soon, just give us an email. We will send you the slides as well in the next few days. Come back to us if you have questions on that. It was really great talking with you guys about the perspectives. And then, I wish you all a good day. And we talk soon.
Thanks for having us. Goodbye.
Thank you very much. Bye.